It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're digging into valuation plays, and I'm here with Ben Emons, FedWatch Advisors founder and Chief Investment Officer. Ben, it's good to see you. Thanks for being here.
Good to be here, Julie.
Yeah, so let's talk about the stock that you think is a better buy right now, and that is Citigroup. Of course, the giant bank here. We've seen the stock do pretty well over the past year or so. So let's get into why you think it's attractive. And first, we start, as I mentioned, with the valuation here. So when we're talking about banks, we usually talk about price to book.
Correct.
And so on that basis, how does it look?
So it looks really cheap to the peer group because it's about 0.7 to book. That's the lowest ratio that's from all the major banks. And it may be to do with the book value in it by itself of Citigroup in this case. As you mentioned, it's not always easy to value, but I think it's a bank that has come out of the financial crisis as a troubled bank, has been in this L-shaped form of this chart if you look back from 2008. And because of the restructuring that's going on, it finally gets some life and finally becomes like more valuable. And that's not reflected in its book value yet. So it's just really a cheap stock.
Interesting. All right. And so the bank has been trying to really, under CEO Jane Fraser, has really been trying to improve things, to slim down, and then also to grow more, right? So what's your sort of grade that you would give that revamp that they've been doing?
So I would give it an A- so far, because you think of Citigroup, it's actually a bank consisting of a lot of different parts. Remember Travelers Group or Salmon Brothers or other types of pieces, and in the financial crisis, obviously got this major trouble. It was a very bloated bank, and it took them years to really work off, but it actually really took the leadership ultimately, from Jane Fraser in this case, that really took dramatic measures, just like recently, where they had, again, unfortunate for these layoffs, but in the case of Citigroup, for how investors reward the bank, yeah, it's somewhat needed to get this 20,000 people that they have scheduled to, basically let go, unfortunately. But yeah, it's for this bank, the revival, and I think this is what's working out so far.
And then there's the other part I mentioned, which is the earnings growth, right, that also has to deliver in order for the stock to go up. And we've seen some promising signs as well.
Yeah, that's interesting, actually. So they have earnings surprises very consistently since 2022. But if you compare to the peer group, they're roughly about an earnings surprise of 15% to the median earnings estimate. Whereas the other banks, who are much more valued than Citigroup is, their earnings surprise is something like 8 to 10% to the median estimate. So that difference is interesting. So you have an undervalued bank that continues to be outperforming on earnings, and yet it's not reflected in the valuation. I think that's why it's an interesting stock.
What do you think would change all of that? What would be the catalyst to get investors to sort of wake up to the opportunity that you see here?
Yeah, I think it's a matter of like recognizing that the consistency of earnings is there. I think they also wanted to see how this restructuring plan really plays out. Because, Citigroup has a big China operation. That's obviously a challenge.
Yeah,
that's what we'll talk about in a second. Yeah. That's obviously a challenge. And then I think it's about just the legacy. Citigroup does sit on legacy assets. It just takes time to work that off.
Gotcha.
I think that's all the reason why.
And you mentioned this challenge here and the risk that the China expansion that they've made, that could be maybe slowed down or hindered if there are more restrictions from the U.S.
Yeah, and that's obviously a sentiment factor here as we're in this tariff trade war discussion. You saw Citi trading up a little bit on these headlines when the deal from Trump-Xi came out, or at least a phone call. It just tells you a lot about that. But then again, it is not so simple. Doing business in China is difficult, and to actually have restrictions from the government, that makes it difficult. So I think that's just the drawback to the story. That's why it is somewhat underperforming its peer group.
Gotcha. All right, let's get to the stock you think investors should avoid. That's AppLovin, which has been really screaming higher. I mean, we saw the drawdown, but now it's still up considerably over the past year, and that, you said, means that it's overvalued.
It's really overvalued. I mean, it trades like 60 times PE, takes in the forward, about 40 times forward earnings. Now, it has had good earnings, and it has actually had free cash flow too, and that's positive. But I do think, I mean, this may be the second point, is that that's just froth building in a stock like this, right? You can not only tell from the parabolic move, but that also that, as this pointer says, like earnings have been good, but it's been slowing down clearly. You know, we've had like record earnings like 2-3 years in a row, and it's really come off that peak. So the stock is obviously went well ahead of this record earnings. So there's a bit of an overshoot there. I think this is what the story is about ultimately. You get a bit of the meme flavor here in this type of stock, right?
Yeah, for sure. And the froth that you talked about, that's also drawn some short sellers to the stock, right, who have tried to come in here and criticize it. And it's come down, but as we saw from the chart, it's still up a lot.
Yeah, it's actually almost up 900% since the start of this year. I think if you own this stock or you purchased it on that time, 900% is a significant gain.
Yeah.
So you could, reallocate to the extent that way. The volatility of the stock, by the way, is also at least 3 times the S&P index. I think it's almost like 1.5 times more than its ultimate peer group, which is like Roblox is one of those companies. So again, frothy stock here. The popular song here is like this McDonald's song, right? AppLovin it, but I think that is not exactly the case.
Not exactly the case. And what could change your mind, right? Or what could continue the momentum here if it got added to the S&P 500?
Well, that's an interesting news item that I saw today. It's going to be announced on Friday. Tomorrow, which companies will be included, and they're on the list. This company has now about 135 billion in market cap, so it enters with an overvaluation and a larger market cap than some of the others that are on that list. So if it is included, then all the index funds have to buy this stock, right? And that's the opposite case. Then it could actually go to the record high from what we saw earlier.
But we'll see, because usually S&P tries to consider some of the things you're talking about when it decides whether to include a stock in the index. So we'll see what they decide.
We'll see what happens.
And do you have a position in either AppLovin or Citi?
I have no position, no client position.
All right, Ben. Thank you so much. And by the way, you're going to stick around and be back with us in a moment. But thank you so much for watching Goodbye or Goodbye, where we bring you new episodes at 3:30 p.m. Eastern.